Alright, so now we're going to look at vertical credit spreads, which are usually just referred to as credit spreads. Credit spreads are primarily used to make a directional or a range-bound bet on an asset by betting where the asset won't go, or at least won't end up by expiration. Let me show you an example of what I mean. Let's say that we have a stock trading along, and you know that based on previous price action, this stock has a 33% chance of ending in its current range 30 days from now. Well, unless a stock is in a strong trend, that would generally mean that the stock would therefore have a 33% chance of ending above its current range, and also a 33% chance of ending below its current range. And if that's true, then if you made a bet that the stock wouldn't end in this lower range down here after 30 days, you would have a 66% chance of winning that bet, because the stock would have a 66% chance of ending in one of the other two ranges, and thus not in your range. Okay, so this is a hypothetical scenario, but it illustrates the fact that it's generally easier to win bets on where a stock won't go rather than where a stock will go. And that's the idea behind the credit spread. By betting on where a stock won't go, you've increased your probability of success, and as long as the trade stays out of the money, theta works in your favor, which is a great plus for this trade. Now, like the debit spreads, there are two types of credit spreads. There's the bull put spread and the bear call spread. Let's take a closer look at each. With a bull put spread, we're essentially betting that a stock or asset will stay the same or go up, because we're selling one higher value put closer to the money and buying a lower value put farther from the money. Now we want to sell our spread as far from the money as possible while still being able to collect some decent premium, because the farther our spread is from the money, the higher our chances of success in this trade. So if our stock is trading at $50, we could sell one out of the money put at the 45 strike for 75 cents and buy one further out of the money put at the 44 strike for 40 cents. And so our max risk would be the size of the spread, which is the distance between our strikes of $1, minus our net credit that we received, which was 75 cents from the option that we sold, minus 40 cents from the option we bought. So that's a 35-cent net credit, times 100 because each contract controls 100 shares, so that gives us a max risk of $65. Our max profit is simply our net credit, which is 35 cents times 100 or $35. Now that leaves us with a risk to reward of 1 to 0.54, and I gotta be honest, I was pretty generous to us in this example. Generally, the risk to reward ratios on credit spreads aren't as high because our spreads are usually far out of the money. And even 1 to 0.54 is fairly high compared to what you would normally see in the market. When trading out of the money credit spreads, I generally aim for a 1 to 0.33 risk to reward ratio or better, just to give you some perspective. Okay, so here's the profit profile of our spread. And as you can see, we're risking more than we can potentially make. But the credit spread seeks to make up this difference by putting the odds of success in our favor, by allowing us to keep all the credit that we received from the credit of our trade if our stock goes up, stays the same, or even goes down just a little bit. So our odds of success in this trade would be likely very high. In fact, it's not uncommon to see credit spread strategies that end up with a 75% win rate or even more. Now let's look at the bear call spread, okay? And as the name implies, with the bear call spread, we're essentially betting that a stock or asset will stay the same or go down by selling a spread made of calls above the asset's current price. So we're simply going to sell one higher value call close to the money and buy a lower value call farther from the money. As an example, if our stock is trading at $50, we might sell a 55 strike call for 75 cents and buy a 56 strike call for 40 cents. And that would give us a max risk of our dollar spread size minus our 35-cent net credit times 100. So our max risk would be $65 in this trade, and our max profit would simply be our net credit of $35. And that would again give us a risk to reward ratio of 1 to 0.54. And here's what that looks like on the profit profile. So the strengths with credit spreads are the high probability of our trades, and also the flexibility of the strategy, since it can be used both in range-bound or trending directional markets. The trade gets sweeter as implied volatility rises, which gives us an opportunity to trade in high IV environments that might be difficult for other strategies such as debit spreads. And as long as your trade stays out of the money, you have theta working in your favor, which is always a plus. The weaknesses of credit spreads are that the risk to reward ratios tend to be generally poor, and that's because we're really just taking the opposite side of the trade of the traders who are buying debit spread trades, if you think about it, and the attractive credit spread opportunities mostly present themselves in high IV situations, which can be rare in bull markets. And because bull markets tend to last longer on average than bear markets, we trade most of our time in bull markets. So good credit spread trade setups can be a little less common. Our two example approaches for credit spreads are the high probability way to participate in the trend, which is our chart approach, and the high probability way to play volatility crushes, which is a pure options approach. And we'll start with our chart approach, the high probability way of participating in the trend. So step one is to identify assets in strong trends where you have a logical long-term thesis. The stronger the thesis, the better. And in the debit spread section of your course, I went over a good example of a strong logical trend to give you an idea of what that looks like. Step two is to wait for a pullback in that trend. Breaches of a 20 and or 50-day exponential moving averages are usually a good general indicator of a strong pullback. All right, but the specific criteria you may use to indicate a pullback may vary from asset to asset a bit. Step three is to place an out-of-the-money credit spread opposite the trend, meaning that if the trend is going up, you would sell your spread below the current price, and if the trend is going down, you would sell your spread above the current price. And your goal is to sell your spread as far from the stock's price as possible, so as far out of the money as possible, to give yourself more room and a greater chance to be right. The limit to how far you sell your spread from the money is that you want to maintain at least a 1 to 0.33 risk to reward ratio. And the farther from the money you go, generally the harder it will be to get that risk to reward ratio that you're after. And the reason why you're shooting for that risk to reward ratio is to ensure that you're bringing in a decent enough credit to compensate you for taking the risk of the trade, okay? So sometimes, in order to maintain this risk to reward ratio, I have to sell only 1 or 2 strikes from the money, and you know what? I'm okay with that if I've done the first 2 steps correctly, and I'm trading something with a strong trend and a decent pullback. Step 4 is to look at previous pullbacks to see how long they typically take to fully recover. Look to give yourself enough time to be right in the trade, and apply a small margin of safety as well. Okay, so the idea is to find out how long it will take that asset to revert back into its trend, and then to sell spreads that give you a little more time to expiration than you think you might need to be right. At the same time, you don't want to give yourself too much time to be right, because then it'll just take too long to make profits, and you won't be using your capital as efficiently as you could be. Alright, on to our next credit spread strategy, and that's the options-based strategy, the high probability way to play volatility crushes. Let me first explain what a volatility crush is. When an event approaches that the market expects will increase the statistical volatility of an asset, such as an earnings release, an FDA decision, and even some economic reports, the asset's implied volatility almost always rises before that event. And it's a well-known fact amongst options traders that for most assets, implied volatility tends to overestimate how much the expected event will move the asset's price after the event. And so option traders can profit from this phenomenon. Let me show you an example. Here we have a daily chart of Amazon, and I want you to take a look at the indicator just below the chart called IV Compare. So this indicator shows the implied volatility of Amazon's options as the red line and the 30-day statistical volatility as the blue line. And perhaps you notice a pattern here, which is that the red line that indicates implied volatility has periodic spikes, followed by not so large spikes or no spikes at all in the blue line. And what you're seeing is actually Amazon's implied volatility rising in anticipation of earnings releases, and then overestimating the impact that the earnings releases have on Amazon's price. In fact, over this time period, you can see that implied volatility overestimated the actual volatility 6 out of 7 times. And you'll notice that immediately after the earnings are released, the implied volatility drops pretty much instantly to very low levels again. And when implied volatility drops from a high level to a low level very quickly like this, it's called a volatility crush. So how option traders can profit from a volatility crush is to wait until implied volatility has risen to very high levels just before an earnings release, and then place an options trade that incorporates selling premium to benefit from the high IV. And then they can hold their trade through that event and through the volatility crush, and then they can buy back their options to close their positions after the volatility crush has deflated the prices of the options that they sold, at which point the trader would profit from the sudden decrease in option prices due to the volatility crush. So with that understanding, let's now look back at our credit spread strategy. Step 1 is to identify assets with very high IV relative to both its average IV and statistical volatility due to a known upcoming event in the near future. Alright, so you're looking for assets that are setting up for a volatility crush. Step 2 is, if possible, analyze the 8 previous events similar in nature for that asset and apply a 20% margin of safety to calculate your expected range. Alright, so here we're building our expected range by looking at similar previous events for that asset, such as the 8 previous earnings releases. And the price reactions after events like this might vary wildly, and that's okay. You're just trying to get a general ballpark figure of your expected range. and then you apply a margin of safety to that average price movement to come up with your expected range. Now, you probably couldn't do this with FDA decisions or other one-off events because you wouldn't have enough data points for that type of event in your asset, but you usually can do this with earnings releases fairly quickly. Step 3 is to sell your spread at or outside that range as far from the money as possible while still maintaining that 1 to 0.33 risk to reward ratio. Okay, and what usually happens is because IV is so high, you're able to sell a spread much farther from the money at that risk to reward level than you would otherwise be able to because volatility is so high. Step 4 is to hold the trade through the event. Step 5 is to take the trade off after the event, assuming volatility collapses as expected. Now, if price did breach your spread and you're at max loss, you may want to continue holding the spread if there's very little time value left to avoid commissions of closing the trade at such a small price and to give yourself a small chance of the price reverting and the trade becoming profitable again. Step 6 is actually more of a tip, and that's that the time frame of your options is less relevant for this trade because we're primarily trading volatility here. So anything 45 days or less will work, and you can just choose whatever gives you the best risk to reward ratio. And actually the smaller time frames can be better if they give you the same risk to reward ratio as the longer time frames. And that's because after a volatility crush, these smaller time frame options have practically nothing left in terms of time value. So the volatility crush tends to have a greater effect on the shorter time frame options, and thus gives you more of that immediate profit using this strategy. Okay, so let's recap the credit spread trade. We can use credit spreads to make directional or range-bound bets, making it a flexible tool. Our max risk is limited to our spread size minus our net credit. Our max profit is limited to our net credit that we bring in from the sale of a spread. Our optimal IV is high because we're sellers of options, so we want to collect as much premium as possible. Our theta is positive when we're out of the money and negative when we're in the money, so most of the time, if you're trading credit spreads correctly, theta will be working in your favor. Alright, so that wraps up credit spreads. Hope you enjoyed.